So first of all, I want to thank IG Bank, Philippe and Mr. Fouad for giving the support of what is an underrepresented subject, trade psychology, but by no means a reflection of how important it is, because I think we all agree. How many people, just a raise of hands, believe that psychology and your mindset is important when trading? Just a quick show of hands. Also to see how many of you are engaging in my survey. Okay, some of you are. Okay, great. And for those of you who are not sure, or maybe just you're still kind of in that pre-lunch mode, that's fine. I'll be asking some questions throughout the session where possible. Most of the session today will be a theory session. Doesn't mean that I'm going to give you lots of slides and it'll be a monologue. I'll try and keep it as interactive as possible. But keep in mind that next week, Tuesday in Geneva, will be the part 2 practical session. So I spoke to some of you, and I think most of you are signed up for both sessions. Some of you didn't know that there were 2 sessions. So please be aware, today is theory, next Tuesday is practice, and we'll be doing the same thing in Zurich. Now, the title of our workshop is Master Your Mind, Master the Markets. For many years, it's been the other way around. Anyone who wanted to understand how to trade or be successful, they've always tried to master that discipline, whether it's the markets or any industry that they work in. I'm putting it to you today that we actually need to start by a self-analysis of what type of emotional kind of situation we're in terms of how we deal with profit and loss, a track record of some kind of experience in the market. Even if you're starting for the first time, it's still good to build up that track record. And all of this helps to master your mind in order to have success in the markets. Now, small caveat, it doesn't mean that having no knowledge of the market it doesn't matter. It is important to have technical knowledge of the market, but we're just saying in combination with self-analysis and actually with a higher weighting towards that area too. So I also have a disclaimer included, just to make sure that we're all on the same page, literally. But more to the point, on previous conversations with Philippe, head of sales here, we discussed a concept called the ripple effect. Do you remember? And we spoke about how dropping a stone in the water leads to this kind of small ripples in the water, which creates kind of further changes or chain reactions. So for me, many years ago, I've been in the market for about 20 years, and I'll give you a little bit more information about myself for those of you who are new to me. But for the years that I've been in the market, the one single change that's really helped me has been just better self-analysis of my experience and my psychology in the market. That's been my ripple. As a consequence, we've had a ripple now with the inaugural event for IG Switzerland in Geneva and then Zurich, and we'll see what the future holds thereafter. But my question to you now, with the pen and paper that you have, is what is your ripple? What is your goal for today? And I know this might sound a little bit cliche to some people, but I think in order to teach successfully, the student needs to be open to learning. And I want to make sure that you have an idea what you want to learn. So I'll throw lots of information to you, but I want to make sure that it's hitting some of the points that you want to receive. So the question I put here is, what is your ripple goal? So if you can write on the paper that you have with you. If you don't have paper, write on the back of the feedback form. I'm sure IG will be happy to know what your learning outcomes are for the session. But write, what is it that you want to learn about trading psychology? What is it that maybe is a little bit gray and uncertain? And more importantly, what's the big challenge that you might be experiencing, if you're happy to be honest and share that information, with trading? And try and keep it non-technical. Because I mean, I'm happy to go into technicals, and my colleague Bruno Estier and myself do that on a regular basis as technical analysts. But right now I want you to kind of focus more on what you feel is the more of the emotional reason or the psychological reason. Okay, have you all done that? Okay, great. You can refer to it during the session. Okay, so a brief introduction on myself, the trainer, and a new subsidiary training organization called Intensity, which is all about basically finding the balance in our psychology and training. There's also a play on energy, the Chinese word for qi, and that's also to do with just that balance and that zone that we need to be in. But essentially, I've been in the market for just over 20 years within strategy, education, and trading for myself, working with leading institutions, banks, funds, and brokers, and during that time, a well-known data provider, Bloomberg, where I serviced their institutional clients buy-side and sell-side across the world. The strategy that I've always employed, for those of you interested on the technical side to my background, has been a global focus. I actually began in FX, but later on learned that nothing works in a vacuum. We actually need to look at things in an interconnected world. So I looked at global markets, multi-asset, top-down, i.e. I started with the big picture first and then drill down with a blended approach. That means I don't just look at technical analysis, I also look at fundamentals and macro too. And a lot of my work is driven by cycles. So if you ask me technically what do I look at on a regular basis, it's market timing using cycles. Now, the area that you're going to be more interested in for today's session is my background in behavioral finance and trade psychology. So the areas which I've always focused on are peak performance. We just had a conversation about that at the beginning, one of the delegates here. Neuroscience and mindfulness. Essentially, they're all part of the same thing. But peak performance is all about being in that peak state, that athlete state. We don't have to be the athlete, but we need to go that extra mile in order to get that extra result. And that's the point I'm going to make to you. Neuroscience and science in general has given us the biggest gift today in that we can now rationally understand things that we did not understand before. So before we had a reason to be ignorant, and I say that with respect, in not knowing certain things. Now there is no excuse for ignorance. There's so much scientific research out there that we can read if we choose to improve our self-awareness and ultimately our bottom line performance in the market. Okay, so that's the bottom line, the show me the money statement I want to give all of you. There is a way of improving performance through self-analysis, but that self-analysis is now more accessible through science and a lot of research out there. And actually you'll hear me quote a lot of well-regarded, in some cases PhD doctor research, just so you can see the amount of credibility out there. Quick point I want to make about mindfulness. That's an open area. I think most of you should be open to the subject. It's become a very fashionable word these days. But essentially, it's being present. It's just being present in the moment. That's all it is. Some people decide to do kind of more kind of active practices like meditation and yoga, such as myself. And some people, they just prefer to be present before a trade strategy. When they're developing a trade plan, they want to just be a little bit more focused. Or when they're having, personal time with the family, playing a sport, they do something to relax in order to unwind the stress. Anyone surprised when I say that trading is a very stressful business? No? Okay, most of you are smiling. Okay, so clearly, if we're excessively stressed all the time, do you think we're going to make money or lose money? Anyone? Lose money. So we're all agreeing on this point. So this does matter. The problem is it's been difficult for people to understand what to do. Okay, so we know these areas are important, but how can we implement them as part of our practice? So for me, mindfulness is something that I do on a regular basis, like I mentioned. It's an active practice, and I've also just done hundreds of hours of mindfulness practice as well. So that helps me in at least sharing some of the information that I'm sharing with you. Last but not least, I'm an active board member on a voluntary basis with the Swiss Society of Technical Analysis, SYNAPTIC, and I also mention that in conjunction with IG because they've been very supportive in doing joint events with each other, and a board member of the global IFTA Technical Analysis Society. They have a designation called the CFTe for technical analysis. And I mention all of this just so you know that my main focus has always been high integrity education. And that's really actually my focus now on the board with IFTA in developing the global education syllabus for everyone who wants to learn more about technical analysis. Okay, so I have an art side to chart analysis, so you'll see lots of images. My charts tend to be a little bit overwhelming to some people, so you might need to wear your winter shades. for them, but hopefully it should be clear. I just want to share a few house rules about my views on the world and the markets. Point number one, beware of the trading guru. Now, in a trading college which I work at in London on a consultancy basis, this is something I say to the students on a regular basis. I actually tell them, if you look at the image on the left, find your own light, don't get burnt by someone else's light. And guess what the students said to me when I said that? But wait a second, you do research advisory and you're on TV on a regular basis, so should we ignore what you say? So I had to be careful what I said then. I said, well, wait a second, if you like what you hear, note it down, but make sure it goes through your quality control. I didn't say that straight away, but that is honestly the response I gave them. Because I was trying to say, if we just copy down ideas, or we just randomly follow people, no matter how successful they may seem, what happens when it goes wrong? And so my point to you today, including the information which I'm sharing with you, make sure it goes through your quality control. Make sure it makes sense to you and make sure it's something you agree with. And if not, it's a great debate that we can all have. But really, beware of trading gurus. Follow your own light. Don't get burnt by someone else's light. And if you like the light that you see, let it go through your quality control. My second guidance on the world is the dangers of make easy money thinking. Now, this might sound like I'm just singling out a particular community, but actually, we've all at some point in time looked for the make easy money trade, including myself. It's you wait for the trade to set up. Some people get a little bit excited and euphoric, and we jump in there. The problem is when we make the money, we think that money is going to continue forevermore, and that's a big problem. No free trade or make easy money trade lasts forever. Nothing lasts forever. So be aware, especially volatility being the key buzzword for 2018, be aware that the market changes. The most constant thing in life and markets is change. And remember, it's about probabilities, not certainties. No one knows the future. We're just working with probabilities. So by definition, you need to be focusing on a strategy that can adapt to the changing market environment based on probabilities. And make easy money is clearly either not existent, or if you found it at any point, it's going to be limited at best. Now here's an example as to why I'm saying what I'm saying. This is a proxy of volatility, the VIX index. This is based on S&P 500 futures. I think most of you would have looked at the chart at some point this year, because guess what? Volatility is back. I've just said it once and now I'm saying it twice. But the key point I want to highlight this to you is A, volatility is back, but B, look at some of the free lunch trades that some people have been making. So in 2016, so after we had the spike in 2015, the spike in volatility, the Chinese currency devaluation was part of the main reason behind that. We had a mean reversion to the downside in volatility. So all that means is things got a lot more easier from a trade perspective because volatility was low. So we got less false signals, the trades were that much more smoother, and you probably saw more trends exist in the market. For 3 years, volatility was in a compression pattern. And some of you might remember February of this year when we had the flash crash just there. Roughly a 1,500 point drop on the Dow Jones in 15 minutes. That should tell you something about the fact that humans aren't in control anymore. It is a lot of automated algo flow that is now pushing the market in a very quick way. But my point is, that flash crash, if you read the news, was on the back of a margin call on volatility. So a lot of institutions, actually, well-known institutions, were doing very well in selling low-vol products. And overnight, some of them vanished. Billions of dollars just evaporated overnight in that spike. And so this was the free lunch of 2018 when we started the year. It was supposed to be the encore for last year and all the other years, because we just had such a great bull market with historically low vol. I did an IG media interview with Jeremy Naylor, one of the resident presenters who's a real favorite of mine. And back then we spoke about how there could be a deja vu signal in the market, so a repeat of what happened here, because we had a second compression range that was taking place. And that was a probability call on my part, and I was fortunate to be correct. And what happened is, at this point, guess what most of the professionals or media headlines were saying? Vol back to lows, you know, things are okay. This time is not different. And this time was different again because we had another spike. Of course, that's the month that just passed, month of October, which is a black month for the year. And that was actually on the back of top of the pops trades. What do I mean by that? I mean anything that looked good, anything that was a sexy trade in terms of momentum, for example. FANG stocks, Facebook, Apple, Netflix and Google, all of these top of the pops stocks and markets fell off the cliff. It was a fall from grace. Now imagine the amount of funds that actually own these stocks. So obviously it would have been a big move, and that would have created some big changes with some of these institutions. But the point is, we've had these two, you know, very good trading environments which have just been reversed. And so this is likely to continue, as I say, not just this year, but as we approach 2019. And as a consequence, this will change investor and trading sentiment. That's my perspective. That's my trading psychology call for 2019. This is going to be a much important subject, and that's why I'm glad that IG are giving it more of a better representation. Okay. Now, how does behavioral technical analysis, as I like to call it, a mentor of mine, Mr. David Fuller, many years ago, coined this phrase back in the 60s. And he made the point that at the heart of technical analysis is crowd psychology. So that's partly the edge that we have when we start to study the basics of technical analysis. And it all begins with the rational investor. So a lot of the academics will say, we're rational. The efficient market hypothesis is the true financial market theory out there. I'm not going to go into that debate. There clearly isn't enough time for that. But the response to that is that we might be rational as an individual, but when you connect us all as a group, like here today, or even bigger around the world, then of course we start to act irrationally. Greed and fear comes into the equation, so those emotional biases which come into the trade psychology. And at some point we start to produce some kind of pattern. That pattern initially might be some linear trend, which we might call the trend is your friend. But at some point, that trend will no longer be your friend, as I just showed you on the VIX chart there, and as you probably recognize on the S&P 500 after it broke below its 200-day moving average for the first time in 2 years, because of the cognitive biases. Because at some point, we reach an extreme. And those extreme emotions lead to the tops and the bottoms in the market. Euphoria at the top, when there's maximum risk, but actually the most amount of money we make, and that's the intrinsic problem. And at the bottom, when there's the most amount of basically pessimism, people hate the market, but as a consequence, that becomes the bottom in the market because there's no more buyers left to buy at the top and there's no more sellers to sell at the bottom. And that creates the cycle. Is everyone clear on where I'm going with this? I'm just trying to lay out the foundation to trader psychology, why it's relevant this year, and how it fits within behavioral technical analysis, which has always been at the heart of the subject of technical analysis. Now, this chart is one of my colorful big picture charts, shows that all of what I'm talking to you about is not random. Very few things in the market are random. And actually, over the last 100 years on the Dow Jones Index, so the US equity market, we can see here that markets tend to cycle in regimes, bull trends or sideways bear trends. And they last roughly from 16 to 18 to 20 years, depending on which cycle you look at. Let's say 16 to 20 years as an average. But I want to focus here more specifically. 2009 up until now, we've been in a very strong bull market, low vol and all the rest of it. But during the green periods, now, during the 80s and during the 60s, These are basically deemed as strong trends with low vol, and I want you to think when I'm going through this how this affects investor mindset. And the strategy which tends to be successful is passive buy and hold. So that basically means most of what you do will be right, and you'll feel very smart. And most of the time, you'll probably make some consistent money, as we have been since 09. And this is obviously more specifically on the equity market, but guess what? Volatility in the equity market tends to spill over to other markets too. Bitcoin just broke through 6,000 and it's pushing down to 3,000. Should be a market that is not correlated to any other asset class because it's a very completely new one. But guess what? When people need to withdraw money out of one trade, they do it across the board. And that's the psychological contagion I'm talking to you about. So although I'm looking at the equity market, bear in mind this is cross-market as well. So I'm talking to you about the green periods, which we have been in since 09. And then the red periods are, of course, weak trends, so sideways to bearish, where the markets tend to be high volatility. We also get a lot of negative news headlines that come out. It's not the news that leads the market, it tends to be the markets that lead the news. And during that time, the strategy that is quite successful is active market timing and astute risk management. So one of the reasons why technical analysis lost some favor in the last few years is because most of the top strategies did well. Now, if and when we get a rotation from an uptrend, low vol environment to a sideways bear trend, high volatility environment, a lot of people are going to be asking about technical analysis. And I predict trade psychology as well, because these are going to be the two very important points. Now, just last point I want to make here is keep in mind I've put based upon a cycle indicator that I use, which maps out some of these changes. 2020 is a potential trigger point. So we have between now and 2020 as a probability of rotation between low volatility to high volatility. So we're likely to get more of the same in the next few years. Okay, now the main focus, I'm guessing the main reason why we're all here is to fill in our performance gap. As traders, as investors, we want to basically be the best that we can be and make the most amount of bottom line possible on our P&L. Ask yourself the question where you think you are on that chart. You don't have to draw it out, but just mentally think about it. Often we start in our trading and investing career, really persistent, really disciplined, and really focused, and we accelerate. But at some point, that acceleration then becomes unsustainable, and we start to plateau and basically go sideways for a while. We remain in a holding pattern, just like the markets do sometimes. It's at this point that it's really important to evaluate what you think your target is. What is your target and how you think you can close that gap. And we'll focus on some of those areas in the Part 2 workshop. But my point here is you need to just keep in mind where you are in order to know where you want to go. Now, the main way to do that is through self-awareness of your own psychology. The turn of phrase is that 80%, roughly 80% of the success of the strategy is based on psychology. Now, some people use different numbers. Some people say 60%, 70%, 80%, whichever number you prefer. The point is, roughly, it's 80-20. 80, psychology is important. 20% is all the technical stuff, like your logical behavior, so the decisions that you make, the risk management, and the trade strategy. Let me be clear. Trade strategy is important. Risk management is important. Logical behavior, we hope, remains important. But the point is, it's not everything. And this is the problem. We tend to go down to the kind of sophisticated path of analysis around the world in one night. We try and remember as much as we can in a very short space of time. And it's natural, because we feel more confident the more information we get. And if we don't have a background in markets, it's a natural starting point for us. But the key is, A, to recognize what I just said, it's 80% psychology, not less. But B, avoid analysis paralysis. Avoid kind of having the kitchen sink with all the knives and forks being thrown at you, to the extent where you actually not sure what to do at a critical time when you need to make that decision. Be aware. And most of the times you actually need to filter the knowledge that you've been gaining, not actually building more, filtering it out. And I've actually spent most of my years trying to filter a lot of information. Especially, think about the questions you might be asking. Which markets do I trade? How much money do I use? What are the best strategies? Which indicators? That's my favorite question, because everyone has a kind of their own methodology, their own process, but how many indicators exist out there? Technical indicators, hundreds. Fundamental indicators, even more. Add them together, big nightmare. News, and I say that with respect, news is important, but how noisy has the last few years been when it comes to news? We were just talking about President Trump coming out with a statement about Brexit. I shan't say any more than that. But that's another noise headline that we're all trying to process and trying to work out what it means for Brexit, what it means for the pound, what it means for Trump and his ongoing statements that still don't make entirely complete sense to me. But essentially, these are the questions that we ask ourselves, and we need to be filtering. This is a key point that I want to kind of focus on as part of the problem of analysis and also trade psychology. So I don't want to sound like I'm just blowing the trumpet for trade psychology and saying it's everything and it has no issues. This is the issue with trade psychology. People have been saying, you know what, trade psychology matters. Ron asked the question at the beginning of the class and we raised our hands. But the problem is we've been programmed that way. We have something called the lizard brain. How many people have heard of something called the lizard brain? Okay, some people have heard. No one else? Okay. It's otherwise known as the amygdala brain. It's a small little kind of, or let's say Brazilian nut. That's the size. In the midsection of our brain. And that part of our brain, that small Brazilian nut, actually controls our fight and flight instincts. What that means is, back in the day, if you can imagine yourself being that caveman or woman, running away from the saber-toothed tiger, it was a really useful thing to have, to know whether you stand and fight or run the hell away and save your life. Nowadays, we don't have saber-toothed tigers. What we have is stress. Whether it's stress in markets, whether it's stress in life, these things trigger our survival instincts and we start to really act irrationally. So for all of the academic or like quantity people who believe that we're rational, this is actually further evidence that we're far from rational, because when this thing gets triggered, the point I make here, we go into semi-paralysis mode. The front part of your brain, otherwise called the neocortex, is your thinking brain. Most of you have heard of the neocortex as another technical word. That research is now showing actually goes into paralysis mode when our lizard brain gets triggered. So imagine that. You can be the smartest person in the market with the best strategy, but if your emotions get triggered, your survival emotions get triggered by maybe losing money, that's a great way to trigger it, your thinking brain, your actual logical mind that we feel so confident about, actually switches off. And we then make mistakes. So that's a great point to know, because at least that way we can stop blaming ourselves and wondering why the trade went wrong. We can kind of think to ourselves, oh, wait a second, that was a paralysis moment for me because I got emotional. But the science helps fill in the gaps, and it also helps us be better aware about ourselves and our decisions. And that's what I'm trying to give you today. So the solution, my solution, and it's not a final solution, it's just a proposal I'm sharing with all of you. And this is work in progress. I'm continuously updating my thoughts and my models on this. Through traders I've worked with, particularly at the college in London, where we train traders on a regular basis, what's always been important in the sessions I've had with them, coaching and teaching, is being in the zone. Everyone talks about being in the zone. One of the ways to be in the zone is to be in a constant peak performance state. And when I say peak performance state, that's more of a sports psychology term, which is obviously used for kind of the athletes out there that need to be in the best human potential in order to win the races. But when I mention it here, I mean a combination or a balance between mind, body, and emotions. mind, body, and emotions. It's never one thing. So I can talk about the brain, but then what about the body? I can talk about the body, but then what about the emotions? They're all very important. Let's start with the brain, or let's continue with the brain, because I've just touched on it already. There's lots of great science in the world of neuroscience, and this picture here looks like this kind of plastic network of information is actually brain cells. So these are cells in your brain just on the left. And latest research is actually showing from neuroscience science that our brain is a muscle. Anyone surprised that our brain is a muscle? But what that means is we can actually either work it out, just like we work out our muscles in the gym, and if we don't, we can maybe deteriorate that muscle and have a lower IQ, but I'm not talking about IQ, less of a responsiveness or improvement on our performance. So the turn of phrase I want you to remember, and write this down if you want, the brain is a muscle, use it or lose it. And I say this often to a lot of the traders as well. It sparks off lots of debate, but really, think about it. A lot of people say automated trading is the way forward, and it is for the most part. Quant and machine learning and AI and all of that is the present and the future. But at the same time, it does not mean that we cannot excel our human potential. And this is my big issue with people who say machine win over man. When did the contest of man begin and end? We're still evolving, and we're still learning how to be better at what we do. And I think this is the issue when we start to give too much dependence on the machine at the expense of the human being, that we will underperform as traders, and probably machines will probably excel even further. So we need to do better. We need to raise the bar. One of the ways of raising the bar is understanding self-awareness, and here's one of the mental states that trigger us all. How many people have felt negative when their performance is basically underperformed? Raise of hands. Okay. I'm hoping all of you have not enjoyed when your performance has gone negative. So that's a big trigger. So that triggers our survival instinct. And we go probably more into flight mode, most people. The response, just a quick mental strategy that I can throw to you, is to try and flip it around into a positive way. Don't be optimistic about losing money. I just said that's not a good idea. But be aware of how you're feeling when you do that. And one recommendation would be to have a trading journal, so that you can not only just follow the price patterns, but follow your emotional patterns. And that actually works tremendously well. A number of traders I've worked with actually really have tangible differences when they actually track their day-to-day mindset according to the P&L. Practice it, see how you feel, and let me know. But by doing so, not only are you being aware, you're also being responsible. The worst thing you can do is to be a responsible trader. And again, I'm not saying that as a kind of a personal comment. I mean a responsible trader. I mean, by definition, you are responding to whatever's happening in the market, and you have the ability to then do something, to make a decision that is for your good. So that's the responsibility. Being able to be aware enough to respond, and then to have the ability to do something about it. And ultimately, you need to be positive about it. You need to think forward. Otherwise, you're just going to continually project negative biases that you've been building over the past. Now, one of the other issues is we're all different. No one person is the same. I'm looking at all of you here, and there's different people. There's men, there's women. It's nice to get a nice gender equality here. There's older people, younger people. I'm guessing there's new people in the markets, and there's senior people in the markets. So we're a real mix of people. The market's exactly the same, and people in life and around the world are, guess what, also different. And there's a lot of psychology studies. The person I would recommend is someone called Myers-Briggs. And some of you might know of the Myers-Briggs test. It's a very well-known corporate personality test that some people are subjected to when they start a new job. But essentially, it's a way of trying to understand what your personality type is. This work is actually incorporated in the work of Dr. Van Tharp, one of the leading world psychologists. This is his book, by the way, and one that was a big key changer for me. I just hold it out here, Trading Beyond the Matrix. And as part of his Super Trader program, where he trains some of the world's best traders, he uses the Myers-Briggs personality test as a way of gauging where everyone's starting point is. And it's through understanding their starting point, then he can then know how to then train and coach them to be that peak performer they need to be. Now, the choice is yours. You're a combination of 4 of these. Now, if you really want to know what type of personality type you are, you need to do like a really comprehensive test. Get the book published by Myers-Briggs. There's several, not one. And then you'll get a better answer. But for now, because we don't have that much time, ask yourself the question, which of these 4 qualities you think you have. You can only pick 4. Some of you I know will choose 2 or 3 because you prefer that number. And some of you who prefer to do the all or nothing approach, you might go for everything on the list. Try and choose 4. I'll say it again, please choose 4. So evaluate your personality trader type. Do you think that you have extrovert qualities? Are you an outgoing person? Do you feel you're the opposite and you have a little bit of introversion in your personality? Are you the sensing type? What I mean by that, you sense or perceive information. Some people call that intuition. Sensing, perceiving, intuition, thinking. Are you the thinker? Analyzing all the time and always kind of number crunching and breaking through the data. Some people hate that. I'm not a big data person, by the way. So are you that type of person? Are you great with Excel? Is that something that drives you? Feeling, again, that's more to do with intuition. And then judging, are you a judger? Do you tend to make certain judgments about markets or people? And finally, perception. So if I could just get a raise of hands, just so I know that you're all still plugged into the session and that this is clear.
If you're both, like sometimes you're extrovert, but sometimes you're introvert.
Yeah, you can.
But where do you draw the line between them two?
So that question I'd need to follow up with afterwards, but there's a lot of grey colour here. I mean, I'm not a big fan of kind of a one-size-fits-all template, but this is one of the templates out there, so that's why I mention it. But yeah, you're going to have overlap, and there are times where you might feel all of them. So in all fairness, I can understand why it might be difficult to choose 4, but research has shown that we tend to be a combination of 4 of these. And these qualities can be used in trader personality tests. Okay, so how many of you relate to extroversion? Raise your hands. Okay, so is it any surprise that all of you sat at the front? I'm guessing everyone else chose not to for other reasons. Okay, so well done for sitting at the front. I'm happy that you're there. Introverts, raise your hands. Now, usually it's a half hand raise. They're not doing this, they're doing this. Or one finger. Sensing, how many of you are more kind of sensing people? You tend to, okay, intuition. So sensing, I'm thinking intuition as well. Feeling. Okay, so I'm seeing the same hands. So there you go. So you raised your hand, sir, for extrovert, but you extrovert with a feeling aspect. So there's no particular correlation. It's really just the mosaic of human nature. We're different for various reasons. Thinkers, who are the big thinkers out there? Okay, so if I were to give you all Excel spreadsheets or data to crunch, you do that very well. Yeah, is that true? Okay, there we go. Judging, this is maybe a difficult one. Okay, so you're good judges. It's not a bad thing. It means you can make decisions. You can take those executive judgments that are required. We need judges. We need people to judge. Perceivers, and I think I asked that question. That's probably people who, any perceivers out there? I'd say that's more closely tied to intuition. Okay, so we have Philippe, head of sales, and a few of you here at the front. Okay, write down 4. So on the paper that you have, write down 4 of these, and I challenge you and encourage you to actually do some research on the internet. You don't have to buy the book by Myers-Briggs, but do some research on this because it will really set you on the path of self-awareness. I don't want this just to be a 1 hour monologue from myself. Really, as much value as you can gain from this as possible. I think also IG would be happy if you gain as much value as possible. So please write notes. Which of the 4 do you think you are? I'll give you just a minute or 2 to do that. And think about it, or sense it, or perceive it, whichever one you are. But really kind of have a moment of reflection to think which one you are. Okay, everyone written it down? Okay, now in a minute or 2, if you could share with your next door neighbor, whoever that might be, let them know which qualities you think you are. So the person next to you, if anyone's sitting by themselves, let me know. I can join. Let the person next to you, so if you can let each other know. And we can share together if you want. Okay. Now's the time to wrap up. I'm glad that everyone's had an opportunity to connect and discuss this. You should have more time for this, in all fairness, but I'm at least planting the seed so that you can begin the process. And the good news is we have a social networking kind of a session afterwards, so you can continue the conversation. And if you have questions about the session so far, I can also help answering more there. But did everyone find that interesting, useful?
Yes.
Okay. How many people have done that before? Just out of interest. Okay. So some of you have already done that before. Great. Okay. Anyway, so how many of you will research this after today's session? I won't be upset if you don't, but I'll be pleasantly encouraged. Okay, great. Let me know how it affects your trading. This is actually very important, and it's yeah, sure, please do. This one? The next one. Ah, this one. Yeah, I thought this one, because this one has the most information on it. So that's a good sign. Please take photos. They should be, and actually some people have been asking, this session, if you hadn't recognized, is being recorded. But more specifically, you might not know this, it will be available on the website. So, yeah. Okay. Okay. Now, as part of the personality type, this is actually less known. So we know about personality type tests. In the corporate sector, it's really popular when they're trying to understand their employees that they're hiring. But this is a real hot topic. What is our relationship with money? And this is something I ask myself on a regular basis, and I don't like the answers that I give myself all the time. But it's important that we have those honest, in-the-mirror conversations. Because the relationship with money will really directly correlate on your trade performance. Anyone surprised by that? No? Now, some of the times it's not really our fault, because a lot of the time we're actually, we've received this through our family heritage, through education, through the friends that we've associated ourselves with, or just a whole bunch of experiences we've had over life. But whatever the cause, what's important is that we deal with the effect. And what is the effect? On the green is the negative effect. On the left, your left, is the in red is the negative effect. On the right, your right, in green is the positive effect. So education, for example, someone negative and pessimistic says, only experts know how to make money, i.e., I'm not smart enough. The positive response would be financial education can teach me how to make money. So if I actually invest time and money in education, then I can learn what I need to learn. Capital, this is a very popular one. I don't have money to invest. And if that's the case, fine. But over time, maybe money can be saved. Maybe some kind of strategy can be developed in order to have the account size that's required. Or, flip side, more rare but true, I have enough money and don't need to invest. Well, I think no matter what the wealth level is, some kind of passive ongoing income is usually everyone's goal. I think most people are happy with that. So size is actually shouldn't be the issue. Ongoing passive income is actually a benefit. For those who want to do that, there should be no limit to how much passive income they develop, whether it's through trading or any other way. The flip side to that is if I don't ever manage my money, then I will never have any money to manage. That's more specifically to those who say I don't have any money to invest. And in the early years when I got started in the industry, I got started in my early 20s and even younger as a teenager, this was constantly told me. You know, for you to trade, because I always said, you know, I want to trade, I want to invest, how do I do that? They said, well, you need to have this amount of equity. And they were right, because there's a certain risk and money management metrics you need to follow in order to have a successful, consistent result. But you'd be surprised. There's some very good traders and investors out there that have turned something into a lot more. And I've worked with some people like that, one or two mentors of mine. Maybe you know some people already. I'm sure IG have spoken with various clients that have interesting track records. So be aware. It's not some kind of secret, and there's not some specific amount in this context. And there's always a way to actually achieve what you want to achieve, is my point. This is my least favorite, and yet it's the most popular. Losing money is okay, I can win it back on the next trade. How many people have experienced that?
The first part is correct, though, of the
Yeah.
statement.
Well, it's
Losing money
true.
is okay.
It's not wrong.
That's fine.
How many people remember their first trade in the market? Okay, great. I'll give. Tell me if you can tell me your experience with your first trade in the market. What was it like?
Well, it was actually, I was 15. It was a win.
Okay, great.
But
Years later.
But I think in a way it might have been a disservice for me.
Yeah.
Because it put me in that euphoric stage. You know, you're like a 15-year-old kid. You make money. What do you think, right? So, yeah.
Guess what? One of my first trades, a long time ago, was a winning trade.
Mm-hmm.
Guess what the second trade was?
A loss.
A loss. And the first trade that I made did exactly what you said. So it's interesting that we share the same experience. Did a massive disservice to me because I got so confident, and I wasn't using kind of stop loss or risk management, sorry to say. It was my first trade. And I had the all-in attitude because I thought, hey, I can do this. And it was only when I lost the second time that I then realized, okay, there's more to this than meets the eye, and then I went in a third time. Did you go in second and third? And
No, of course, yeah. Then the downward spiral began afterwards. The realization of, okay, this is a bit more complicated.
did you break even in the end?
Well, it's complicated.
Okay,
But
complicated
to
I'll
answer
take.
your question- to answer your question, over the long period of that time, no.
Okay, understood. And these are stages of our progression, by the way. I'm not trying to single out any one person. We spoke before the session, so you're a trusted kind of delegate that I can connect with. Thank you. Thank you for being honest. And by the way, we can all learn from each other, so that's why it's great when each of you can engage. And remember, this is a safe space. So, be open to sharing what you wish to. The flip side of the risk side, obviously, is risk management is paramount. So although losing money is not okay, but it's probabilistically certain, you shouldn't have the mentality that you're just going to win it back on the next trade. You should be reducing the amount of risk that you have in general over time. So risk management is paramount. Don't risk more than 2%. Now, different people have different numbers, but generally it's 1 to 2% if you're an active trader. Why do you think 1%? Why is 1% a magic number?
Oh, sorry, if I may.
Please, and if you could say it out just loud so everyone can hear.
If you're injecting the probability factor, obviously if you risk like 10%, after a certain amount of time you're going to be wiped out of your account. But if you use 1%, it will allow for your edge over time to still be intact and you to be a profitable winner in the long run. Hence the 1 or 2% ratio, to allow for those series of unfortunate events to occur, but not wipe out your account.
Thank you so much. Did everyone hear that clearly? So 1% is your probability roll. That means you have 99 more shots in the so-called kind of trader machine gun. If you had 10%, guess what? You only have 10 shots. So if you're right, great. If you're the wonderful sniper and you're able to kind of really ping out the best trades, go for it. And some investors need to do 10% because that's the leverage or the risk requirements. But if you're an active trader, the 1% rule is a very good one. And here's a small tip I'll give you as well. If you're maybe in negative equity or you're just feeling really uncertain about a trade and you're probably losing some sleep, the wife or the husband's stressed out by you or whoever who's close and dear to you, reduce the risk on your trade. It will do wonders for you. Reduce the risk of your trade. You do not have to max out the risk. And again, it's not about get rich quickly. You can actually build equity slowly. A lot of people do that. And also, you can do it more consistently. Okay, so I'm going to rush through the last few slides because we're almost out of time. That's all mind and psychology. The last few slides are to do with general health, fitness, but also the emotional bias. And I'm going to take it from a different angle. So in terms of body fitness, so clearly this is part of the peak performance perspective. Athletes, in order to prepare for a certain competition, prepare their physical body. We don't have to be athletes. And for those of you who like athletics, great. But not everyone is. But having some kind of an active, energetic lifestyle is good for general health, but extremely good for trading. And it's no surprise some of the top traders out there have active fitness health lifestyles. Imagine how you feel energetically if you know, you haven't been doing that much exercise, you're sitting at the computer for way too many hours, and I've done that many times. At some point you're going to miss something or you're going to make a wrong decision. So activity for many reasons is really a key to the success for being a trader. And it's up to you what you do. The second point, diet, is a real kind of hot topic which I'm going to try and shoot over really quickly because everyone has like a fanatical opinion on what is a good or bad diet. The point is try and avoid the average day trader diet, which is, you know, high stimulation, coffee, sugar, processed food, which you don't know, you know, what's in it for the most part. But even worse, eating at the desk, and I'm sure some of us, if not all of us, have done that. But there's a lot to be said in actually just really choosing your food. Try and eat food that you've made where possible, especially if we're talking about, you know, regular dietary food. And just be aware of the stuff that is going to give you high energy and the stuff that's going to give you low energy. There's lots of ongoing research on this in terms of what's good, what's bad. You do what you feel is best for you, but just be aware that food matters. And most of the time people say that food matters more than fitness. So again, one is not more important than the other, but together you've got a better chance of actually excelling in the market. Yes?
Yeah, it's the same principle for athletes who eat. Like they'll tell you, you talk about trading 80% psychology, 20%. Well, for the athlete part, it's diet, high percentage, and then the actual exercise, the lower percentage.
Thank you. And sir? Yes?
Avoid to get stroke in case of collapse in the market.
Avoid?
To get stroke. Good diet, avoid to get heart attack.
Ah, yeah. Well, absolutely. Wherever possible, stay alive.
Actually,
yeah.
This is what happened. A lot
Yeah.
of people, they collapse and die.
Yeah, yeah.
And,
So literally, tragically, literally, but actually metaphorically, some of the top traders actually say to be successful, you have to trade boring trades. And the hedge funds are not going to say yes to this, but let's say trade boring, consistent trades. And guess what the second part is? Stay alive. Keep the account alive. And hence the 1% rule for how much you risk on a trade so that you have 99 more shots to stay alive. Probabilistically, you have more of a chance, no matter how bad or good you might be, to stay alive. So literally, tragically, but actually metaphorically, it's a very good point. So balanced diet helps you just stay healthy, and actually for health reasons, that's a good thing, but also for peak performance reasons, it's key. Calming exercise I'm going to touch on at the very end. I specifically use the word calming exercise as opposed to mindfulness or meditation or any other kind of more new agey fashionable term, just because different things work for different people, and I don't want to convert people to different things. Do what you feel is best, but the point is, if you're living a stressful and trading a stressful lifestyle, you need to be able to balance it out with something. And just think about the amount of stress that we're plugging into our brains and our body every single time we're about to place a trade, or even for people who are just analyzing the markets. I know whenever I look at the markets and it's very volatile, I get stressed. We all do. Keep in mind that the stress is something that can be tracked. And in the coming new year, I'm actually going to be purchasing equipment that measures this stuff so that people can actually see it on a computer screen, and they can see brain waves in this case. And you can see, and I don't have the slide here, but the brainwave that we are constantly in when we're active is called the beta brainwave. Everyone, I think some of you already know that. It's not a big piece of information, but most successful traders try and drop that brainwave down pre-trade and post-trade in order to actually get to that zen or that trading in the zone state. And you can do that through calming exercises, but understand that it changes the actual brain waves that you're actually experiencing. And what that looks like is this almost close to the end of the presentation slide. This is what I mean, but I say the signals that the body is receiving. It's not just your brain, it's also your heart. We tend to focus a lot on the brain and neuroscience and everything, but the heart communicates with the brain and vice versa. And the point I want to focus on here is this technical term called coherence. I haven't written it on the slide, but that's the term. If you're feeling stressed or fearful, you're panicked about something, the signals that your biochemistry is creating, based upon how you feel, triggers this type of response in the body. Very volatile, kind of zigzag kind of movement. And that is called incoherence. You see that? Incoherence, frustration, anxiety, worry, irritation. This actually impairs performance. So remember when I was talking about your brain going into semi-paralysis mode when you're making those logical decisions? This is part of that process. And then when we go into coherence, when we're feeling positive, a little bit of appreciation, love and care for those of you who are more open in that way, we tend to have more of a harmonic frequency in our body, and we tend to be more healthier, we tend to make better decisions. This is no big news. What's new is that the information is now available for you to be able to look at this and actually do something with it. Guess which state is better for trading? The red one or the blue one?
The blue one.
Blue one, great. We're all on the same page. Okay, guess which state we tend to be when we're experiencing emotional extremes? The top one, the red one. So if, the way that you can, start is by being aware. Attending this workshop is step one. But then you also need to be able to kind of track, maybe through a trading journal or just through general exercises that you do on a regular basis, to see how you're able to regulate your state of mind and emotion. Keep in mind that emotions drive the market. We start with optimism, into excitement, euphoria at the top, maximum reward, but maximum risk. And at the bottom, we have denial when the market corrects. We're experiencing denial at the moment in the market. People are not sure whether they should buy on the dip or not. Then we go from denial to fear. I think we're between the two. And then finally into panic stage and depression stage. At the depression stage, as I mentioned, that's low risk, high opportunity, and that's what makes a market, that's what makes the cycle. But what I always tell people is, trade the patterns, study the patterns, trade the patterns, but also understand your own emotional patterns, because it will actually help your performance through all that I've been saying today. Last but not least, the final slide is kind of a positive, upbeat note to let you know that our states, our mental and emotional states, can be modeled. And this is the work of a PhD called Dr. David Hawkins. And he's basically developed a model that believes that we have these levels of mindset or consciousness that we experience. And so the red zone is what we need to avoid. That's anything between 20 and 175. So anything, we start at shame, guilt, apathy, grief, fear, between 20 and 100. Between 125 and 175, desire, anger, pride. Anger, by the way, 150 is otherwise known as a revenge trade. You've lost money in the market, you jump back in to make the money back again. But you're not doing it because of a balanced mind or balanced strategy. You're doing it to get revenge back on the market. So your anger tends to take control. All of this is really unproductive and will lead to negative equity. Level 1 is where you need to be aiming for. You're more happier, more productive, and then obviously as far up as you can go. The tangible tools I want to suggest to you, and this is just a proposal, is, for those of you who want to learn more about mindfulness, I'll be talking more about that in the next session. We'll probably have an exercise on mindfulness so you can actually experience what it's like, or at least begin to do it on a regular basis. There's a phone app for those of you who like to download things on your phone called Headspace. It's one of the top mindful apps in the world, developed by a very well-known mindful expert. And they have kind of 1 minute, 2 minute clips that you listen to. It's a guided meditation, guided mindfulness. And a lot of traders use this, by the way. The last thing I would suggest is something that we'll potentially send to you. I think, Yannick, is possibly true. And that is a test that was developed by Dr. Van Tharp. He's the gentleman I spoke to you about at the beginning, who's one of the world's top trading psychologist. I've done some basic collaborative work with him. He's publisher of this book. And he developed what he calls a happiness test. Sounds a little bit strange, but it's just a way of measuring your mindset, where you are on this scale. You can start low, progress high. You can start high and go low. I mean, it depends on how we change from day to day. But it's a way of measuring your progress. And the idea is not to measure it at a point in time and leave it. The point is to use it as a measuring tool and to see how you're actually improving over time. So we can send you a link for that. And actually, for those of you who are attending the second session, I really encourage all of you to take the test just so we can actually engage more and share that information and discuss ways that we can use it to improve your trading performance. That's it for my session. I'll take questions and answers, but just a moment before I do, part 2 next Tuesday, just to remind you all, is the practical session here in Geneva on Tuesday and Wednesday tomorrow in Zurich, and next week Wednesday. Questions, please.